the direction of the economy in 2022. We need to remember back over 40 years, we've probably been in the most benign economic climate in human history. Declining real and nominal interest rates beginning in 1982 from admittedly a 17.5% prime. U.S. dollar hegemony on a global basis. So as Americans, we could export our problems to other people. The demographic benefit of the baby boomers, which is of course over, the good and peaceful part of globalization and free trade. We're now in a much more mercantilistic economy. But I think of particular note has been what you describe, which is to say the increasing amount of debt and deficit relative to the private economy. Let's look at some arithmetic just for fun, Frank. If you measure the deterioration of the purchasing power of your dollar, which is to say your cost of living, by the CPI, you will believe that inflation is running at 2.6% a year. That varies pretty dramatically with what you're experiencing at home. The price of gasoline at the pump, the price of food. Notice that the CPI doesn't include food or fuel when it's inconvenient. An odd index for someone who either drives or eats. Notice, too, that the CPI doesn't include tax. Now, a cost of living index that doesn't include the largest component of most household expenses is fairly silly to me. I did a thought experiment over the last 4 years, and I attempted to measure, improperly and anecdotally, loss of purchasing power for my own savings and investment in the purchase of goods and services necessary to maintain my life. By the way, I don't describe taxes as a service, but that's a different, and they certainly aren't good, but let's leave them aside. I have to pay for them. And what I have discovered is that the purchasing power of my savings diminishes as about 7.5% compounded in US dollars. So that's an anecdotal number for me. That is to say, the decline in the purchasing power of my savings. The yield I get on my savings, the real yield, if you define them by the U.S. 10-year Treasury, the world's benchmark savings instrument, is 4.3. So I get paid 4.3 in a currency where my purchasing power is declining at 7.5. In other words, the value proposition associated with the world's foremost fiat currency is that you lose about 2.5% of your purchasing power a year, perhaps 3, compounded over 10 years. If anything at all would make me concerned about the efficacy of fiat-denominated savings products, it's a government-guaranteed loss. There are, of course, other things. There are other things that concern me. The predilection of the political class to deal with any economic circumstance through counterfeiting. They call it quantitative easing. From a saver's perspective, the printing of more specious currency units does not make every existing unit more valuable. It makes it less valuable. And then, of course, there's the credit quality. As you know, I'm an old credit analyst, and I look at the on-balance sheet liabilities of the United States government exceeding $34 trillion, or $28 trillion net of the Fed's own balance sheet, which is to say net of counterfeiting. And I look at the other side, at the net present value, not nominal value, but rather net present value of entitlements, Social Security, Medicare, Medicaid, federal pensions, military pensions, environmental trust funds, stuff like that, exceeding, by the estimate of the Congressional Budget Office, $100 trillion.
Let's reflect on the economic landscape we've experienced over the past 40 years. Since 1982, we've lived through a period of declining real and nominal interest rates, starting from a 17.5% prime rate. The US dollar's dominance has allowed us to export our economic problems to other countries. The demographic boom of the baby boomers fueled economic growth, and the peaceful era of globalization and free trade created a benign economic climate. However, this era is over, and we are now facing a much more mercantilistic economy. One of the most alarming trends has been the increasing amount of debt and deficit relative to the private economy. Let's look at some arithmetic for a moment. If you measure the deterioration of the purchasing power of your dollar by the Consumer Price Index, CPI, you might believe that inflation is running at 2.6% a year. However, this figure varies dramatically from the real experience of most households, especially when considering the price of gasoline, food, and other essentials. The CPI conveniently excludes food and fuel when it's inconvenient, making it an odd index for anyone who drives or eats. It also doesn't include taxes, which are a significant component of most household expenses. A cost of living index that doesn't account for such major expenditures seems rather silly. In my own experience, I've attempted to measure the loss of purchasing power of my savings by tracking the costs of goods and services necessary to maintain my lifestyle. What I've discovered is that the purchasing power of my savings diminishes at about 7.5% compounded annually in US dollars. This anecdotal evidence highlights the real impact of inflation on everyday life. Consider the real yield on savings instruments like the US 10-year Treasury bond. Currently, it offers a yield of 4.3%. But if your purchasing power is declining at 7.5%, you're effectively losing about 2.5% of your purchasing power annually. Over a decade, this compounds to a significant loss. This scenario raises serious concerns about the efficacy of fiat-denominated savings products, which essentially guarantee a loss of purchasing power. Another troubling aspect is the political class's tendency to address economic circumstances through quantitative easing, a euphemism for printing more currency. From a saver's perspective, this practice dilutes the value of existing currency units, making them less valuable. The U.S. government's on-balance sheet liabilities exceed $34 trillion. And when considering the net present value of entitlements like Social Security, Medicare, Medicaid, and federal pensions, this figure exceeds $100 trillion. Given this staggering level of debt, it's difficult to understand why anyone wouldn't own physical gold. Personally, I own gold not as a trader, but as insurance. It helps me sleep at night, providing a hedge against the financial uncertainties that loom over us. While a financial planner might argue that I don't need to own gold given my large shareholdings in Sprout, I still hold it because it offers peace of mind. The real value of gold isn't in its price fluctuations, but in its ability to preserve wealth over the long term. Since I began adding to my physical gold stack in 1998, it has treated me very well, averaging an 8% compounded return. Impressive for an asset often dismissed as unloved. For those interested in more active investing, gold and silver stocks can offer significant returns, but they require careful selection and diligence. The beta of gold equities, their performance relative to the broader market, can be spectacular during bull markets. However, this comes with increased volatility and risk. Investors must be willing to do the necessary work, such as reading quarterly reports, balance sheets, and resource statements.
It's very difficult for me to understand why people wouldn't own physical gold unless they have access to investments that have built-in inflation hedges, which is to say owner-operated, moderately leveraged real estate where the operator has the ability to outcompete other folks. Mm-hmm. I own gold personally, although a financial planner would tell me I didn't need to, given my large shareholdings in Sprott. Mm-hmm. I own gold personally as insurance. I own it because it helps me sleep nights, which is a very good thing at 71 years of age. I don't own gold as a trader. I don't own gold because I think it's going to go from 2,400 to 2,700. I couldn't care less. I own gold because I'm afraid it's going to go to $9,000 or $10,000. That's why I own gold. And by the way, since beginning again to add to my physical stack in 1998, it's treated me very well. Eight and change compounded for an unloved asset is pretty good. Investors in gold stocks or speculators in gold stocks, two different breeds, must look at something very differently. I remember that you have a talent for technical analysis. If you look at gold market beta or gold equities beta, when we come into a period of a gold bull market, the simple beta, I would define beta as the delta between the performance of the gold equity sector and the broad equity sector, is spectacular when we come into a gold bull market. For those speculators seeking alpha, and I know you have a sense of humor for that too, which is to say individual small stocks where you take advantage of information asymmetry in the market, for those people willing to take the risk and do the work could be extraordinary. But I would argue that investors, when they seek to answer the question as to which asset class they might own, should look at themselves in the mirror. What type of investor are they? How much risk are they willing to assume? And most particularly, how much work are they willing to do? If their primary consideration is reading more books, doing more gardening, spending more time with their kids or grandchildren, then I think they need to own the physical gold. They need to own it as insurance. If they're willing to do some work, if they want to balance their equity portfolio, keeping in mind the beta in gold during a gold bull market, they should do some work, but you need to do just a little work and find the 4 or 5 or 6 best gold mining companies in the world. For those people who are seeking alpha, for those people who are attracted to 10 baggers or 20 baggers, please understand that you have to subject yourself to a lot of volatility and a lot of risk. And in order to do that, you have to commit to doing a lot of work. Frank, you may know that anybody who wants to can go to ruleinvestmentmedia.com and list their natural resource stocks. I personally will rank them 1 to 10, 1 being best, 10 being worst. As a consequence of that, I've ranked about 80,000 portfolios in the last decade. And the one particular lesson I've gotten from that is that most speculators own way too many stocks. And their technique for selecting them seems to have been got a hunch, bet a bunch. I would suggest that speculators limit the number of stocks they own that they want to work on their portfolio. And by working on portfolios, I don't mean listening to Rick Rule or Frank Curcio podcasts. I mean reading quarterly reports, reading balance sheets, reading resource statements, reading management information circulars, reading proxies. If you're willing to work 10 hours a month, you should consider owning 10 stocks. If you're willing to work 20 hours a month, you should consider owning 20 stocks. If you aren't willing to work, you shouldn't own any speculations whatsoever.
As we continue our exploration of the value of gold and silver, it's crucial to address the different types of investors and their strategies. Understanding your own investment style and risk tolerance is key to making informed decisions about incorporating precious metals into your portfolio. There are various types of investors in the gold and silver market. Some are long-term holders who view these metals as insurance against economic instability. Others are more active traders looking to capitalize on price movements. Then there are speculators seeking high returns from smaller mining companies. Each approach requires a different level of commitment and understanding. For those who prioritize stability and minimal risk, owning physical gold and silver is the best strategy. These investors should focus on acquiring coins and bars from reputable sources, ensuring they have a tangible asset that can be used as a hedge against economic downturns and inflation. Active investors and speculators who seek higher returns must be prepared to do their homework. This involves researching and selecting the best gold and silver mining companies. Speculators, in particular, need to be aware of the high volatility and risks associated with junior mining stocks. However, for those willing to take on the challenge, the rewards can be substantial. It's important to limit the number of stocks in your portfolio to a manageable number. This allows you to thoroughly research and monitor each investment. As a rule of thumb, if you're willing to spend 10 hours a month on your portfolio, you should consider owning around 10 stocks. If you can dedicate 20 hours, you might manage up to 20 stocks. The key is to focus on quality over quantity and to stay informed about the companies you invest in. One of the significant challenges in the gold and silver market is the manipulation and suppression of prices by large financial institutions. This artificial influence keeps prices lower than they might otherwise be, creating an opportunity for savvy investors to accumulate precious metals at attractive prices. China's approach to gold accumulation is a perfect example of strategic buying. Despite reporting modest official reserves, China is the world's largest gold producer and has been steadily increasing its holdings. This quiet accumulation strategy aims to bolster their reserves without driving up global prices. While gold often gets the spotlight, silver is equally important and holds unique potential. Silver is not only a precious metal, but also an industrial powerhouse. Its applications in electronics, renewable energy, and medicine make it indispensable in modern technology. The demand for silver in solar panels, in particular, is set to rise as the world transitions to renewable energy sources. Let's address some viewer questions. Many of you have asked about the best ways to invest in gold and silver. Should you buy physical metals, or are there other options? Investing in physical gold and silver, such as coins and bars, gives you direct ownership of the metals. This provides a sense of security and tangibility. However, it also comes with considerations like storage and insurance. Alternatively, you can invest in paper gold and silver through exchange-traded funds, ETFs, mining stocks, or mutual funds. These options offer convenience and liquidity, but lack the tangible security of physical metals. Both approaches have their merits, and a balanced investment strategy might involve a mix of both. Incorporating gold and silver into your investment portfolio offers both protection and growth potential. These metals act as a hedge against inflation, currency devaluation, and economic uncertainty. They provide a form of insurance for your wealth, ensuring that you are prepared for whatever the future holds. At the same time, gold and silver offer opportunities for growth. Their value tends to rise during economic downturns and periods of high inflation, providing a counterbalance to other investments that may be struggling. By diversifying your portfolio with precious metals, you can achieve a more balanced and resilient investment strategy. Before we wrap up, let's lighten the mood a bit. Imagine a tweet that says, "Investing in fiat currencies is like putting your money in a leaky boat. Gold and silver are your lifeboats." Financial freedom. It's a humorous yet accurate way to highlight the stability that precious metals provide. Here's another one. Why did the investor buy gold and silver? Because even during a financial crisis, they wanted something shiny to hold on to.